It's always interesting. I love like the slogans of these big Wall Street firms like UBS. It's you and us. It's them and them. It has nothing to do with you. They just want to sell you stuff. But this is why analysts are always bullish, right? Because if I came out and said, hey, you know what, next year, market's going to be down 20%. Your first response is, okay, well, if you're saying the market's going to be down next year, I'll just go to cash and I'll just wait it out. Problem with that is they don't make any money. They can't sell you anything by being bearish.
The Real Investment Show.
And welcome back to the show this morning. So we're going to talk a little bit this morning about kind of Wall Street analyst estimates for next year and kind of a range of outcomes. But before we get to that, I need to kind of give you some background on why analysts are always bullish, right? So when you're listening to the media, when you're listening to Wall Street analysts, et cetera, they're always bullish. And there's a couple of reasons for that. And the first is that it's easier to be bullish than bearish. Why? Because you're going to be right more often than you're wrong. 85% of the time, the market is rising. About 15% of the time, the market's actually declining, right? So you're having a bear market about 15% of the time. You're having a bull market about 85% of the time. So on this chart, this is a long-term chart of the S&P going back to 1900. And the black lines are where the markets are making new highs, right? So if you think about you'll hear this statement all the time. It's like, well, if you just invested in the markets in 1900, you would have made 8% a year, blah, blah, blah. Well, that's true on average, but markets don't compound. In fact, what you will notice here is that there are very long periods between where markets make highs and where they make the next set of highs. In other words, they spend a lot of time just recovering previous losses. And that's a huge difference than making money when you're just recovering losses. So what's always important about investing is when you start investing, not if you start investing. But it's important, though, that yes, the markets are going up a vast majority of the time. And that's why bullish, analysts are always bullish. It's just easier to say, hey, next year the markets are going to be up because the odds of being wrong are really in your favor, right? I mean, 85% of the time the market's going to be bullish. So if I'm bullish, the market's going to be bullish, and I can say, hey, see, I was right. Markets were up last year. That doesn't necessarily mean anything. It's just that's why that's the case. But it's important to also understand that it's just a really big business for Wall Street. Now, we've talked about this, before, and it's important. But back in the 60s, 70s, even the early 80s, right? Guys on Wall Street, brokers, we called them stockbrokers back then. They weren't financial advisors. This has been a new marketing twist term. But back in the day, you were a stockbroker, right? And your job every day was to, call a client, sell a stock, and make a commission. And that was actually a much better way of doing things because you as the buyer, you'd pay a one-time commission to own a stock. You'd sell it for a one-time commission. And that's really a much better deal than the structure we have today where everybody pays a fee, right? And you buy an ETF and you have this fee that you pay every year, which is much more expensive in the long term, but it's great for Wall Street because they annuitized all their businesses, right? We invented mutual funds first. And this was like, oh, look, instead of you just buying all these stocks, buying and selling them, you just put them into this fund. We're going to charge you an annual fee and we'll do all the buying and selling for you, right? You just buy and hold. And this was great for Wall Street because all of a sudden they didn't have to sell new stuff every day to make revenue. They had to come in. They actually just had to accumulate assets, tell you to just buy and hold. It was great. And they just collect an annual fee. So now they annuitize a revenue stream. And this has been great business for Wall Street. It's for the top 24 firms. I went and ran a calculation on the top 24 firms in the investment banking asset management side. It's almost $1 trillion a year in revenue, right? That's just 24 firms out of all the financial firms that are out there. But it's huge business, mutual fund business, pension funds, hedge funds, but anything I can get you to invest in where you just pay an annual fee is great, right? It's not really that great for you. Commission was way better. Pay $25 to buy something, pay $25 to sell something, but people held these things for an average of 6 years, right? So your actual expense was very low back then. And now you're paying a fee every year to own these ETFs or whatever it is. And the message from Wall Street is just buy and hold. Why? Because, well, markets go up most of the time. Most of the time. But this is kind of an interesting thing now because, again, it's important as we start looking at the markets themselves. So again, this is, who's the real client here? And we're going to get into this in a second, right? Who's the real client? But have you ever wondered why every stock is rated a buy or a hold? Right. Nobody's, there's very few stocks out there ranked to sell. Have you ever wondered why? I went and ran, I went to Zach's research and I pulled down a list of every stock that they cover in their universe, which is over 5,000 stocks. It's 5,170 stocks that they cover in their research. I pulled it down and then I ranked them by which stocks are rated a buy, a sell, or a hold. Right now, this is not Zach's ratings. They have their own rating system for stocks, which is much better. But this is the average Wall Street analyst rating on these stocks. Out of 5,170 stocks, 4,335 were rated buy or strong buy. Now, do you mean to tell me that you honestly think that 4,335 stocks out of 5,170 issues, and then you can throw the other hold issues in there as well, because that's just a polite way of not saying sell. So 4,800 to 5,170 rated either a buy or a hold. Why is that? Why is that? So why are these ratings that you use to buy or sell stocks like, oh, it's a buy rated stock, I need to buy it? Why are they all rated buys? Well, this is where it comes down to really understanding where you rank in terms of Wall Street, right? And it's also a function of why you need independent advice and analysis that is independent of how Wall Street works. But the Wall Street Journal went and they did a survey, and they surveyed all the Wall Street analysts out there, and they asked them a question. They said, how important are the following to your compensation? In other words, how you get paid. And so your industry knowledge was number one, your standing in the analyst rankings and the broker votes, right? So they all vote for each other who was the best. Your professional integrity, your accessibility and responsiveness, your relationship with management of the companies you follow, your success at generating underwriting business or trading commissions, your written reports, number 8, number 9, the profitability of your stock recommendations was at the bottom of the list. It didn't really matter whether or not their recommendations made were right or wrong, or if their accuracy and timeliness of those forecasts were right or wrong. Those were at the bottom of the list. What was important is how they were ranked among the other brokers and analysts out there. Were they more popular than the other guys? And did they generate any business for the firm? That's what was important. Now, let's go to the next one. So question number 2. Question number 2 was, how important are the following clients to your employer? Number 1 was hedge funds, followed by mutual funds, defined benefit pension plans, insurance firms, endowments and foundations, high net worth individuals, and at the very bottom of the list, retail brokerage clients. Now, when you start taking a look at all these ratings that you're told, you're saying, hey, you just need to buy and hold this ETF. You just need to buy and hold this. You know who doesn't buy and hold? Pension funds, hedge funds, mutual funds, insurance companies, major investors. Warren Buffett doesn't buy and hold. He may hold something for a very long period of time, but he sells stuff. But you're just told to buy and hold this. Why? Because you're the person they're selling all this stuff to. Have you ever wondered about an IPO? IPO, so it's like, hey, this company's going IPO, so you want to run out there and buy it. Why? Why would you want to buy an IPO? That's like me having a steak at my restaurant, right? And it's the last steak that's there, and I can sell it to you for any price I want, right? I can sell it to you for a massive premium. And this is the way that IPOs work. The mutual funds, the hedge funds, the defined benefit pension plans, the insurance firms, those are the guys that invested in those companies when they were private. Goldman Sachs was going to bring this company public, and they went around and they did a roadshow with these hedge funds, these mutual funds. Hey, you're going to buy into Uber, right? And then we're going to take it public. And when we go public, you sell all your shares. The insiders of these firms are the ones and the brokerage firms, right? Goldman and JP Morgan, this is why they do IPOs. It's huge business. It's huge revenue business for them. But who do they sell the shares to? You. They're going, you should buy these shares of this IPO. It's awesome. This is a great company, IPO, right? We're taking it public. And so all the people that bought into it when it was private are selling their shares to you at a huge premium. So you have to understand where you fit on the list. So when you listen to these Wall Street recommendations, you have to understand where you are on this list. Wall Street doesn't care about you. Wall Street needs you. Wall Street needs you to sell product to. That's what Wall Street does. Wall Street is a product generator. They generate products to sell to you. That's why, during 2020, 2021, when we had all that influx of capital, what did we have going on? Massive rush of IPOs. And we couldn't get IPOs out the door fast enough because there was so much demand because all these people had insurance money, government stimulus money. They came up with SPACs, right? It's like, we can get SPACs out faster when we get an IPO, so let's just SPAC these companies out. We don't even know what we're going to invest in. We'll just do a SPAC. People will give us the money. We'll have it, and then we'll just go try to find something to buy. But that was because of the demand. And so again, when there's a demand for product that will generate revenue, Wall Street will feed it to you. It doesn't matter if it's a good product. It just matters that they fill that need for you. Now, understanding that, when we come back from the break, we're going to talk about Wall Street estimates for 2024, where they think the market's going, and we'll kind of review the last couple of years to see how well they did. Don't go away.
You're listening to The Real Investment Show.
So, understanding now, as we talked about last segment, that Wall Street's not really in this game for your benefit. And it's always interesting. I love the slogans of these big Wall Street firms like UBS. It's you and us. It's them and them. It has nothing to do with you. They just want to sell you stuff. So just kind of keep this in mind. But this is why analysts are always bullish, right? Because if I came out and said, hey, you know what, next year, market's going to be down 20%. That's, your first response is, okay, well, if you're saying the market's going to be down next year, I'll just go to cash and I'll just wait it out, right? Problem with that is they don't make any money. They can't sell you anything by being bearish. That's why they're always bullish. And this is because bullish sells product. And that's all this is. And the reason that you want to be bullish is because I can sell you stuff. So if we go back to 2021 as an example, in December of 2021, Goldman Sachs came out and said that the S&P would climb 9% to 5,100 in 22. 2022 turned out to be a year where the market was down over 18% after including dividends. So clearly a big gap between what Goldman said was going to happen and what actually happened. But that's okay, right? So they obviously got it right the following year because, 2023 was a good year, right? I mean, we're almost at 5, we're at 4,800-ish here just recently. So, I mean, obviously 2023, they certainly nailed that one, right? So, if we take a look at the Wall Street targets for 2023, this was a list of the 10 companies on the 19th of December of 2022. Barclays Bank was estimating 3675. Where was Goldman? Goldman said 4,000 on the index for 2023. Problem with that is, of course, is that what they assumed and what actually occurred two very different things. So, these forward analysts, these forward estimates are, very wrong. And, the problem is that, had you been investing based on these forward estimates, well, it didn't really work out that well for you. So what is saying about 2023? Well, here's the latest so far. This is now these are going to change, right? This is early, so we're gonna get some more out here towards the end of the year, and the closer we get to, the market high for the year, these all get ratcheted up for next year. But Deutsche Bank at 5,100, Goldman's at 4,700. Goldman's saying, hey, you know what? We're gonna be lower next year than we are right now, right? So. Will they finally be right? I mean, eventually they're going to be right? Well, they're hardly ever right on these estimates. And again, this is generally the case with things, and certainly something to consider. So here's the important thing. Throw all this stuff out the window. It's not important, right? We go through this annual ritual of everybody kind of, our 2024 outlook is the economy's going to do this and the market's going to do this. Nobody knows. What we do know and what we can work with is that we can work with valuations, and we can make some assumptions on valuations based on the things that we think could happen, and then we can develop a range of outcomes that we can invest with. And that's kind of the exercise in today's article. So if you take a look at forward earnings estimates right now for the S&P, they were at $227 a share. That was the initial estimate for 2024. Those have already fallen to $220 a share. So already down $7 on forward estimates, but we'll use the 220. Now, just understand that between now and this time next year, when we get to the end of 2024, that number will be lower. But let's just use 220 as a basis for our exercise today, and let's do some valuation modeling based on some different things. So the first thing is let's assume no recession next year. And we assume that, well, if there's no recession next year, we could probably maintain the same valuations this year, at 22 times earnings. And at 22 times earnings, based on $220 a share, that gives us a target of $48.45 for the market next year. Now, we're already at basically 4,600-ish, right? From 45, 4,600. So it's not that much of an upside to maintain 22 times earnings. And again, that's assuming that we stay at $220 a share. At 22 times earnings versus a lower, earnings per share growth. So if we get down to 210, right, 200, it's going to change this number. But we have a range, right? We have an upper end of our range now of a market with no recession at 22 times earnings. Now you can pick other valuation measures. Just, again, this is just a mental exercise for you to go through, and you can do this at home yourself. Just pick some ranges and say, okay, if we do $220 a share, and I think valuations will be this next year, they'll give you a target. But let's assume that we have a soft landing recession, right? So this has been one of the theoretical outcomes for next year, is that higher interest rates, lower economic growth, we kind of get this mildish recession. It's not a financial crisis type recession. It's just a normal run-of-the-mill recession. Valuations in theory should fall to about 17 times earnings. That's not a big drop from where we are currently. We're at 18 now, so you go to 17. At $220 a share at 17 times earnings, that gives you a target of $37.44. So obviously some downside risk. That's about 17% decline next year. So there's certainly a setup here for a recessionary outcome of the markets. And if we take a look at normal recession links and take a look at recessions historically and the average drawdown, 17% is well within the context of a recessionary drawdown over time. So, again, the average recessionary drawdown is 33%. So 17% just, is kind of a mildish, soft landing-ish recession. It's not terrible. Nothing falls out of bed. So certainly within the realm of normality. But let's assume that we have a year like this year. We also need a bullish scenario, right? We need a scenario that we have a multiple expansion. So in other words, we have $220 a share, but people are willing to pay up for that. And so in that environment, we're looking at a very different outcome, which is an environment where we have valuations expand to over 24 times earnings. Now that'd be up from 24 times earnings, where we are currently, but that's that multiple expansion. And that's very similar to what we've had this year. So 2023 was a year where the vast majority of the gains this year came from multiple expansion rather than earnings growth. So this is a good viable target. Now, if you have 24 times earnings of $220 a share, that gives you a target of $53.95. So base call it $5,400 next year. So now we have a range of outcomes. So we've got a recession outcome, we've got a kind of a normalcy outcome, and then we've got this really bullish kind of outcome. And so if we put those onto a chart, we can kind of develop a range of outcomes for next year that run the gamut from a decline back to testing kind of those October-ish lows or retest of those lows. And that's certainly well within the realm of reality of how markets work. So, again, kind of this retest of previous lows would not be surprising at all in a mild recession type outcome. If you have just kind of a no recession kind of normalcy outcome, and by the way, we did this analysis last year, and the target last year was 4,650, exactly where we're trading now on this kind of normal outcome. So again, the market's exactly where this exercise that we did last year predicted the markets would be this year. So again, on that kind of a normalcy, no recession outcome, you're talking, basically kind of, just barely testing new highs for the markets. And then of course you have your more bullish optimistic outcome at 220 times 24 times earnings, getting us close to 5,000. So that's a range of outcomes, and that's a pretty broad range. Now, what you'll notice though is that the upside is much less than the downside. Your risk reward basis next year is not great. And that's because of the economic environment and because of assumptions. And again, now this is all nobody knows what's going to happen next year. I don't know. Nobody knows. And this is why when we talk about this, making assumptions and forward, kind of forward forecasts, those type of things, nobody knows what next year is going to hold. But by developing a range of outcomes, we at least have some probabilities and possibilities that we can work within in terms of managing portfolios and establishing some guidance of where things are going to be. Now, there's a chunk of you out there right now going, I think the market's going down 17%, and that's okay. Right? And then there's a chunk of you out there that are going, I think the markets are, going to 5,400. And then there's another chunk of you that says, it's probably where we are right now. We'll just have a flat year next year. Yeah, those are all possible outcomes. The problem is don't get wed to any one of them. No, we don't know where they're going to be next year. We have a range of outcomes, so we know what our risk and our reward is. Right? And so we can manage portfolios for that range of risk and rewards, but we have no idea how next year is going to turn out. All right. You're listening to the Real Investment Show right here. That article on the website right now, if you want to go look at all the charts and the graphs, the analysis, it's on the website, realinvestmentadvice.com. If you're subscribed to our newsletter, you'll get this by email as well today. So if you haven't subscribed to our newsletter, do that at the website, our daily market commentary. And be sure, if you're watching the show, please like and subscribe to the show. We appreciate it very much. We'll be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.